Welcome back, options traders. Happy Hump Day Wednesday to everyone. And I've got another good question for the group. Did you lock in profits? I hear this a lot from traders, and they'll say, well, for instance, I rolled this option so I could lock in some gains. And the reason that you want to learn these different strategies is to lock in gains, and then we can continue to move on with new trades. Well, the question is, did you really lock in profits? Well, it's a common phrase. I'm sure you've heard it. Might even be one of those people who says it. But the question is it really true? So let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So let's start off with an example. Let's say we have a long call, and I'm just going to say that you bought the $100 call for $6. So yes, your maximum gain is unlimited. There's no limit on how high a stock's price can go, but your maximum loss is $6. And so if we look at the expiration risk graph, here we go. So recall that we always get a bend, this little corner right here at a strike. So we can see that this is the $100 strike. That's another good way to show that options hedge risk. It flattens out down here. You can only lose the $6. So now let's say that the stock has moved in your favor and you decide to roll to the 105 strike for a $4 credit. So you're going to move from the black line to the blue. And again, the reason that the blue line is shifted above the black by $4 is because of this $4 credit. You used to have a maximum loss of $6. Now you've got $4 in your pocket. So now you could say that the maximum loss is $2. And visually, that's what's happening. We're just walking this risk graph to higher and higher positions on this graph. So even though you might say that you've reduced the amount you could lose, it doesn't come for free. Because if you got a $4 credit for a $5 roll, that's just the difference between the strikes. If you got a $4 credit, there's actually a $1 increase in your break-even point. So we've got the 100 strike plus 6, that was the initial trade, gives us a break-even of 106 right here. But if you have an effective cost of $2 after the roll, then your break-even here on the blue line is the 105 strike plus the effective $2 cost, or 107. So the break-even used to be 106, now it's 107. So yes, you are shifting this part higher, the maximum loss, but you're also shifting out those profits to be lower and lower. And we can see that here because the blue line sits below the black in this region. But once again, the main thing to see is that the main motivation for the roll is to reduce this maximum loss. It is far more about risk management than saying, oh, I just want to get a bunch of money or I'm generating credits. That's not it at all. It's just to reduce the downside risk. So let's say that you get another chance. The stock moves in your favor and you're able to roll from the 105 to the 110 strike for another $4 credit. Well, now you're going to move from the blue line to the green. And once again, this blue line has been shifted higher by the $4 credit. You used to have a maximum loss of $2 on the blue line. Now you've got a guaranteed gain of $2. And we can see that because this last roll right here to the 110 strike sits entirely above zero. So you've got a guaranteed gain of 2. Some people will look at this as a negative cost basis. It's as if somebody paid you $2 to take the 110 call. So how did you get here? Well, remember the sequence. You started off by spending $6, then you rolled for a $4 credit, rolled for another $4 credit. So we have $8 in credits combined with the initial $6 cost, gives you a net cash flow of positive $2. And that's how we got this entire curve to sit above zero. And this is where a lot of traders are going to say, oh, I've locked in $2. I cannot lose that. Somehow I've got this absolute guaranteed position. Well, the question we want to really address here, did you really lock in $2? And like a lot of problems with options, it depends on how you look at it. But there are definitely problems when people say, yes, I've locked in $2. So problem number one, and this is probably the biggest one, it doesn't account for the current call's value. And this is the house money fallacy, which I've talked about before. People say, oh, it's as if I've been paid $2 to get this call, and we ignore the current call's value as if it just doesn't have any value, as if even if it goes to zero, it's not going to matter to us. Well, I doubt that's going to be true. So take a look at the sequence again. You started off by spending 600. You collected 400 from the first roll, 400 from the second roll. And so yes, now sitting over here in your money market is $800 cash. However, you shouldn't just stop there and say, oh, well, I started off by spending 600 and now I've got a guaranteed 200 bucks. Because you still have this option. Remember, you rolled to the 110 call. And let's just say that it's trading for 12. And in fact, it could continue to increase. That's potentially your money. All you have to do is click on sell. And this money now goes into your money market. But the fact that you're leaving it out there exposed to price changes, this is really what you have to watch. So your total account value, according to your broker's platform, let's assume this is the only position in the account, is $2,000. So again, you started off with $600 in the account, you've got $800 in the money market, and you've got this long call for 12. So the broker is saying that the total account value is $2,000. Now again, whether that's really the only position in the account doesn't matter, just isolate it. Since the beginning of this trade, you've gotten to a position where it's worth 2,000 bucks. So the question is, if this call option goes bust, let's say it goes to zero, are you going to see it as though, yes, it was worth 2,000, but it's worth 800, and so I'm still up 200? I doubt it. I think you'd see it as though you went down $1,200. It's not really going to be too comforting to say, well, you started at 600 and now you've got 800 in cash, so you're still up 200 because you've locked in 200. So the main point to take from this is that, yes, it's okay to say that you've at least gotten your initial principal back, and that's certainly a good point or a target to strive for with risk management. But don't forget that if you're continuing to roll to different options, that's part of your account value too. Again, all you have to do is click on sell, and that's going to be right into your money market as well. So make sure that you are accounting for, after your rolls, that you're not just looking at the part that's guaranteed because of the cash. Also remember that you're holding a new asset. That's what you have to account for when you're addressing the risk. All right, so what's problem number 2 with saying that you've locked in gains? Well, let's say that you, in the previous slide, that you actually click on close, you sell it to close, and you put that money into your money market. And so now it says that it's $2,000. Well, is that money locked in? Right? Your total account value says $2,000, but the question that I have, how is that locked in? Are you going to take this out and stick it into T-bills forever? Or bury it in a coffee can in your backyard and say that it's locked in, that this is a high water mark, it can't move? Well, of course not. You're most likely going to put it into another trade at some time in the future. So why is it safe to think that this is a high water mark, that you've locked in some gains? And see, when traders say that in their minds, they start thinking, oh, I've got pretty much everything guaranteed. It's all locked up. And they're not aware of these new positions that they've rolled into, or what their values are, or what the risks are, and the Greeks and everything else. They just keep telling themselves that they have profits locked in. And that can be a very dangerous way to approach your trades. So remember that each trade stands alone. Avoid saying that you've locked in gains. Now, yes, you can certainly say that you have capital gains. You paid $600, you sold it for $1,000, you've got a $400 capital gain. That's fine, but don't say that it's locked in, because again, that's just going to give you false confidence. So what's the risk? Well, remember that risk is always what's exposed to price changes. So in the previous example, yes, your money market we had set at $800, and that's not going to budge, barring any small amounts of interest that are deposited to it, but it's not going to move because the markets are up or down. However, in that same example, we showed that the long call was worth $1,200 for a total of $2,000. So yes, it's true that the money in the money market, this $800 here, may not be at risk now, but it most likely will be in the future. So again, it's just absolutely wrong to say that you've locked in something. It's just a capital gain and it's going to get reinvested at some point in the future. The other thing is when you say that it's been locked in, is that it makes people want to sell too soon. Oh, I paid 6, I can sell it for 7. That way I've locked in a gain. It can never be taken away. Let me move on to something else. Again, like that's a high watermark. It's not. Each trade stands alone. Is it better to leave it in the current position or is it better to move on? And that has nothing to do with what you paid for it. And then the final thing to remember, one of my favorite quotes from Carl Richards, who said that risk is what's left over when you think you've thought of everything. So just because in this example, let's say you've got a call that's worth $1,200, don't say, well, RSI is at this level, or my Fibonacci extension say the stock is going to this level, and therefore it's not really risky. That is not true. That's just false confidence. Because everybody can see RSI, everybody can see Fibonacci extensions. It's known. That's not the risk. The risk is everything over and above that. And by definition, there are things that you can't know. So what's the better way to approach it? Well, the first thing is, hopefully from this video you've learned, avoid the use of, oh, I've locked in some gains. Instead, learn to hedge your positions. Have a goal and say, is this going to allow me to meet my goal? Let me take a certain amount of risk to meet that goal and let me hedge away the risk that I don't want. But what you want to avoid is the phrase locked in, because that only leads to false confidence. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on the YouTube channel Options A to Z's Facebook trading group, where you can find all of the archived videos from our trading forum, and you can find a link in the description below.